Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about how active fund managers or active share investors fared last year through the volatility. There's two types of funds management, active and let's call rules-based or passive management, which I've spoken about before, certainly a lot in my book, but even on this podcast as well. Active fund managers typically use their skill and experience to pick which stocks to invest in, whereas the alternative to active is just to invest in index funds that invest in a broad index. One criticism of index funds is they just blindly invest in a broad index, and that might not always make a lot of sense because index funds sort of ride through the highs and lows. And of course, if we think about last year, there was a lot of volatility and arguably potentially a lot more capacity for active fund managers to outperform. And I wanted to go back and see did they, and really uncover that sort of performance. So if we think back through last calendar year 2020, between the start of the year 1 January and about mid-March when sort of the COVID thing broke out, the international share index fell by about 20% until about mid-March. And then from mid-March to the end of the year, rebounded by about 40%. And for that whole calendar year, the return was about 11%. So that takes into that's hedged, so it excludes currency fluctuations. So down 20, up 40, year to year, up 11%. So quite a lot of volatility, and the Australian market didn't do as well, but still had quite high volatility. So the Australian share market fell by about 27% to about mid-March, and then rebounded by about 33%. But still finished about 3% down for the year. So very much, you'd describe both of those experiences as a V-shaped recovery. But that's only really part of the story, because I think the market's reaction to the COVID situation potentially created, or certainly in hindsight created, some good long-term investing decisions, or opportunities I should say, and it punished certain sectors of the market significantly more than others, and probably the most punished were oil and gas, airlines, travel and tourism, real estate, and banking. So really, they got smashed around a lot, more than others. And potentially, if you're an active fund manager looking back and taking a long-term view, there was some opportunities there. So really, in a bull market, that's when all stocks are rising. Using an index fund in that situation gives you a broad-based exposure and probably, makes sense or logical sense that you would capture most of the returns. But potentially people might think it's logical that in a bear market or a market with a lot more volatility, that's where active investors will outperform, because that's when you can pick stocks, or hopefully your stock picking will do better than the broader market, which is not so great in the first place. So, for example, technology stocks were doing incredibly well through most of that sort of midpoint of that COVID period, so the middle of last year. And then as vaccines started to emerge, the sectors that were originally punished the most, so the oil and gas, airlines, travel, tourism, those sorts of sectors, they started to recover quite strongly. So admittedly, and certainly with the benefit of hindsight, an active fund manager could have been, say, overweight technology for the first half of 2020, and then switch to the recovering sectors for the remaining part of the year, and that approach, in hindsight again, would have outperformed. Now, of course, we're all wiser in hindsight, and perhaps it's a little unfair to conduct that analysis. But the point I'm trying to make is that if you're going to pay an active manager higher fees than, say, what you'd have to pay an index manager, surely you've got to expect some sort of return on that investment. Surely you've got to expect that they're going to use their skill and experience to identify those opportunities. So let's see how they performed. And I look at what's called the SPIVA report, which is Standards & Poor Index versus Active report, which is updated every 6 months and essentially compares the performance generated by active fund managers and then calculates the proportion of active fund managers that failed to beat the index. So it gives you a sort of active versus passive, and who are the winners, who are the losers, if you like. And I've got a link naturally in the show notes and the blog on the website to that report. So if we have a look at the performance for the year, the calendar year 2020, we can see that in the US, 60% failed to beat the index. In Australia, 56% failed to beat the index. In Japan, it was 54%. And in Europe, actually, only 37 or nearly a third of the market failed to beat the index. But really longer-term performance really tells the story and is far more compelling evidence, I would suggest. And generally, over any 5-year period, approximately 75 to 80% of active fund managers fail to beat the index. And really, of the 20 to 25% of active managers that actually do beat the index over a 5-year period, it's not the same managers each year. In fact, the data shows that there's less than a 10% chance of a active fund manager outperforming any more than 2 consecutive years. So you've really got to switch to the next fund manager and make sure you pick that correctly. Therefore, in summary, excluding Europe, less than half of active fund managers beat the index last year, which I think is a pretty poor performance. So it's certainly better than longer-term performance because arguably there was a lot more upside to beat the market or beat the index last year, but you would expect more active fund managers to perform better in that sort of environment than what they have. Another thing to recognise is that a lot of active fund managers are very scared to underperform the index because it's really not good for their business. It makes them less popular, attracts less inflows, less money to manage and so forth, and it's just not good for business. So they tend to construct their portfolios to closely replicate the index. They don't want to go too far away from what the index looks like because that minimises the risk of underperforming. And this is what they call index hugging. So you start to invest in an active fund manager because you think they're going to actively make investment decisions that are going to benefit you in the long run. But really what they're doing is you end up with a sort of quasi-index, if you like. And why would you pay an investment manager between 2 and 10 times more in investment fees just to replicate the index? Of course, that would be dumb and you shouldn't and wouldn't do that. Similarly, active managed funds rarely go to cash. So one of their risks is if they're not fully invested in the market and the market takes off, it's always very difficult to make up that underperformance because they miss the boat and they miss the returns. But really, if you're going to employ high conviction active manager and they really have a strong investment case to reduce investment exposure or even go fully to cash, you want them to be able to do that. But the reality is that commercial imperatives and tensions means that they tend to want to stay fully invested. So the upside is that really in a year that provided lots of investment opportunities, and ones by the way that still rules-based index investing still allowed us to capture because we were able to use value fund managers, for example, that are going to skew to those sectors that look better valued than the sectors that didn't. So again, oil and gas was a big one that screamed out. We made certainly some investments in the energy sector to benefit from the rebound. But banks was another one. So a lot of our value-based index methodologies, particularly here in Australia, were heavily invested into banks, so heavy exposure into banks, and that served us really well through the recovery. So you don't need active fund management necessary to sort of pick those market trends or benefit from them. But certainly, as we can see, given less than half of active fund managers beat the market last year, we know that active funds management doesn't really provide that benefit. Instead of referring it to as active versus passive, I like to call it rules-based investing, because rules-based investing includes traditional index funds, but also factor-based investing and all the sorts of things that I talk about. It differs from active investing because a rules-based fund doesn't have to pay an expensive portfolio manager to make a lot of subjective decisions. Instead, they use rules-based sort of quantitative methodologies that are typically rooted in sound academia research in order to make our investment decisions for us. So there's a few advantages to rules-based investing, of which I've spoken about, as I said, a bit in this podcast previously. But just to summarise and to reiterate some of those benefits, the first one is obviously better longer-term returns. And I've talked a little bit about that and used last year as an example of a year that was a bit of a gift, if you like, to active fund managers, but they've failed to sort of capture that. And it eliminates the risk of trying to pick the right active fund manager, by the way. So, of course, there's always exceptions that prove the rule. There will be active fund managers that beat the index, but you don't, using a rules-based approach, you don't have to pick them. You don't have to take that risk to pick which managers are going to outperform and then when to dump those managers because they will eventually underperform. Secondly, much lower fees. Active fund managers tend to charge between 1 and 1.5% per annum, whereas index funds range typically between 0.2 and 0.4%, but some even much lower than that. And lower fees mean lower risk because you don't have to outperform to cover your fees by a greater margin. Lower taxes. Typically, index funds tend to be more tax efficient because the fund turnover is a lot lower, and so therefore the income versus capital gain is different. So less realised gains means less tax along the way, or at least you pay each year and you get to reinvest your capital gain tax-free until you obviously sell the investment. So lower turnover, lower tax. And fourth, they're more diversified, and diversification tends to be the common thread or common theme, if you like, where outperformance is achieved. And so, for example, if you look at an international index fund, Vanguard, for example, holds more than 1,500 different individual stocks, whereas most active funds hold less than 100, and often fewer than that. Often a lot of those active managed funds hold 30 stocks or something like that, so they have more concentration risk. So what can we learn from this analysis and this experience last year? Well, firstly, there's a huge body of evidence and a growing body of evidence that demonstrates adopting a rules-based approach to investing in the share market is likely to generate better returns net of fees and taxes. That's not to say, of course, that every active manager will fail to beat the index every year. Of course, there's going to be outliers. Of course, there's going to be better performers. But if you want to adopt a investment methodology that has the highest probability of generating more than adequate returns, a rules-based investing strategy is the way to go. Secondly, 2020 has proved yet again that investing in the share market, you must be prepared for volatility. So typically there's going to be one really major volatility event every decade or so, and then there's going to be smaller volatility events every 2 to 3 years. The best thing to do when they occur is to close your eyes and ears and focus on long-term outcomes. Remain invested, enjoy the upside, and realise that volatility is just natural in markets. And if you're not able to do that, well, maybe share investing just isn't for you. I hope that's been a useful exercise. As I said, we've got more data and links on the blog on the website and, of course, in the show notes. I'll remind everyone, if you enjoy the podcast, please do leave a rating. It's the way it achieves a higher ranking on Apple and other platforms. And until next week, bye for now.